Hello, everybody, and welcome back to the Velocity channel, where this is your bridge to financial freedom. Today, I want to go ahead and get rid of another gargantuan loan. Thank you, Henry. $110,000 is going to be the loan amount, but we are going to reduce that down. And can you believe this is 40 years? I told you there's 40-year mortgages that these people are having, but listen, it doesn't matter if it's a mortgage, a student loan, a car loan, whatever loan it is, payday loan, title loan. This is how you take care of loans in the 21st century. But before we get into that, like, share, and subscribe so that everyone around the world can know the power of Velocity banking. So here we have a loan that is $110,000. So we're first of all going to write it out. I know a lot of times we may have some anxiety. We may have some issues when it comes to our debts, but if we write them out, that is the first step to solving them correctly. All right, so let's go ahead and write it out. Okay, $110,000. This particular one's going to be at 11%, and then we have the minimum monthly payment. Now, before we get to the minimum monthly payment, all right, let's go ahead and see how much interest we are going to be paying the bank. Do you know how to do that? Let's go ahead and share with you how to do that. We take the $110,000, okay? We're going to abbreviate the 1,000 with a K. We multiply that by 11%. Now remember, that's going to be turned into decimal form, so we got to place it as 0.11. You'll find out that that actually equals $12,100. So we're going to go ahead and place that $12,100 right there. And then what are we going to do with that $12,100? All right. We're going to divide it. Remember, this is the same calculation for the line of credit as well. We're going to divide it by 12. Why? Because there's 12 months in a year, and that's going to give us a number. That number is about $1,008. Okay? CJ, why is that important? Well, you're going to see why that is important in our calculation in a little bit. Remember, I told you that when it comes to the minimum monthly payment, which this one is $1,021 each and every month, when it comes to the minimum monthly payment, this interest rate plays a factor. Now check out the first month of this payment. Remember, this is getting divided, a lot to the interest, right? And then some for the principal. Let's check out how this is getting divided in the first month. So the first month, you've got $1,008 going towards interest. And $13, you read that right, going towards the principal. Now, wait a minute. $1,008, $1,008. We could tell how much was going to the interest through our calculation. That's how you get the lender to make sure they're telling the truth, okay? Don't fall for those miscellaneous fees. So make sure you're reading the paperwork, all right? But in the 12th month, what do we see? We see it going down just a little bit to $1,007. And how much you're going to principal, that's going up $1, $14. Then we go to the 24th month, which is $1,005 going towards the interest. And then there's $16 going towards the principal. Do you see the pattern there? As this goes down, that's going up, but only by very little. And that's by design. Now, did I tell you that this one is a 40-year amortized loan? Do you see why the lenders implemented the 40-year rule? All right. So the 36th month, we have $1,003. So it is going down. And then on the principal, it's going up $18 towards the principal. They want you to spend as long as possible paying this loan. Remember, the lenders get paid by time as well as by interest. Now, if you want to do this, that's fine, okay? If you want to continue up this payment schedule, that's fine with me. But what if I were to show you another schedule whereby you didn't have to be taking advantage of the banks all the time? Is that okay? Let me go ahead and share with you how to pay the $110,000 off and not take 40 years and not have over $380,000, guys. $380,000 in total interest. Listen, that deserves an exclamation mark. That's how much you're paying in interest if you're going to pay the bank's way. Now, let's go ahead and share with you. If we took just $500, and you're like, well, wait a minute, CJ, just $500? I don't want to spend an extra $500. Well, what if I could show you a way for you to actually find the $500 in whatever you're spending right now? What if I were to say you do have the extra $500? And if you placed it towards this principal, and I'm talking about the principal, you've got to pay the right way, that you could capture this number much sooner than if you would have paid the traditional banking way. All right, let me show you how that happens. Whenever you have an interest rate, right? This is the first month. Remember, the bank is going to take theirs. So, of course, it's going to be $1,008 on the first month. But this time, you're going to do something different. You're placing that extra $500 inside of this principal. So it's not going to be $13. It's going to be $513. Now, what does that do to the principal? Well, that drastically reduces it so that at the 12th month on the Velocity banking side, how much are you paying the bank? $954. And on the principal side, it's $567. Do you see how much that has gone up on the principal side and the drastic reduction at the 12th month versus barely a reduction at all on the 12th month on the traditional banking side? Let's go ahead and continue. This pattern is going to keep up all the way through the 36th month. So you have on the 24th month of the second year, $889. And then on the principal side, it's $632. While on the 36th month, $815. And then the principal side is $706. No wonder you're getting out of this loan much quicker than on this side. Would you like to know how much quicker? How much quicker? On this side, you'll be paying a total of $71,589 approximately in total interest. Now, folks, when I was in school, they taught me that 71 was less than 380. Did they teach the same thing? On this side, you're going to be spending $380,000 in total interest. And you're going to be paying that $1,021 for 40 years. How old are you right now? Are you even going to be alive in 40 years? We have to ask these questions, and we have to have critical thinking in this area. We've got to know how to calculate the interest so that the lenders are not taking advantage of us. All right? Folks, over here, in what year are you getting out of this gargantuan loan? In 10 years. In about 10 years, you're done with this loan on this side. You understand? You're done with it. You don't have to worry about spending another $1,021 to pay off this loan because this loan is already done in 10 years. Where And what could you do with $1,021 for 30 years? What could you allocate it towards in order for you to gain in wealth, to have assets that actually pay your bills? Did you know that that's how bills are supposed to be paid? Through your assets, not through your hard-earned money. Your hard-earned money is seed money, meaning, hey, let's go ahead and put it into a project here. While the assets, right, cash flow, right, from rentals or other business adventures, you can place towards your bills and other expenses, all right? That's how you're supposed to think in the 21st century. Listen, there was a time where the horse and buggy was a very, very good mode of transportation. But nowadays, we have automobiles. We have things that have an engine. An engine that can take us places. Allow velocity banking and the system that is already here for you to make sure that you're going to places faster, safer, a lot less noise, and a lot less stink. Okay, let me go ahead and get out of your way so that you can screenshot this, you can go over it. Remember, anytime you have a principal and interest, you're going to go ahead and see how much you're going to pay in interest. This is how you do it. The calculation or the formula is the principal multiplied by the interest. That's going to equal those interest dollars for the year. Okay, that's going to interest dollars, and you're going to divide it by the month to get how much you'll owe the bank. Okay. But in velocity banking, we want you to owe less and less and less to the bank. That's what this was all about. Folks, if you have any questions, don't hesitate. Go ahead and drop me a line. And listen, the credit card companies, they do take advantage of you. And they take advantage of you in three ways. Through the minimum payment details, through the statement due date, and then, of course, the interest rate. Let's reduce the principal that we're paying so that we reduce the interest that we're paying. That is how it works. God bless you, and we'll see you in another video.